Hello, everyone. This is our first live Growth Spotlight episode in Growth Spotlight format in the last 3 years as NBT. We are trying to cover the most challenging growth questions. Today, we have Mr. Daniel Sawko. Daniel is one of our most resourceful mentors in the community. He has been initiating lots of intros for the new mentors and stakeholders, as well as he has been covering workshops and mentorships around fundraising. Last but not the least, his startup, ShipShape, is providing free investor access to the founders. And Daniel, I'm really glad to have you in the community, and I'm really glad to have you under the spotlight today. Let's start with the introduction.
Thank you, Eren. Always a pleasure, and it's great to be involved in the community, and I was honored that you asked me to do so. And there are always such interesting companies that are part of the NBT community, and we definitely see where we can play a role in helping those companies. So by way of background and introduction, so I started out, I did economics at university, went into management consulting, and ended up working at a tech company. And that company was fundraising. And the founder said, Daniel, can you go research which investors you should go and speak with? We should go and speak with about our Series A fundraise. And I thought, well, sure, how hard can this be? And very quickly realized that actually trying to find investors that are interested in a particular domain is really difficult. And if you're a founder that's building the rocket technology that's going to take us back to the moon, actually there's only a very small subset of investors globally that understand that particular domain. You also, as a founder, tend not to have that much cash lying around. So you can't necessarily afford access to a database that, for example, a fund or a bank might have access to. And so we thought, well, actually, this is holding back human progress. It's holding back the progress of those founders who are building the future. What if we were to aggregate data from around the world and give that access to research on investors directly to founders? What then happens? And we're really pleased with the results in terms of how many companies we've helped, and also how much those companies have then gone on to raise, which is just over $2.1 billion US dollars, which is, we're really pleased with that sort of return, as it were, on the platform.
In our accelerator programs, most of the time we ask founders about their goals. And when we are asking them, divide the goals into whether they are trying to find the end users, whether they are trying to find distributors, partners, or whether they are trying to find the investors, because all of the paths are going in different directions. When it comes to the investor path, before fundraising, when it is time for a founder that they can realize that they can start fundraising, or in other words, let's say, what is the minimum viable asset to start fundraising for a founder?
So I think actually knowing what you want to do with the capital is number one, and how you're going to best de-risk an investor putting in that capital to your company. And I would always frame it in that type of way. So why is someone going to part with cash in exchange for shares in your company? And all the assets are ultimately being built around that. Investor needs to build conviction in order to part with their cash in exchange for shares in your company. And that then feeds through in terms of the assets that you're producing, and the why you're producing those assets. So there's a lot of emphasis in today's world on how good is your pitch deck. But the pitch deck is really, it serves a purpose. The pitch deck is not the end product. I think one of the things that I've definitely observed in the market is around the founders that use the pitch deck as a means to an end, i.e. it's a means to me getting a meeting with an investor. That's a much stronger approach than I'm going to give you a pitch deck and then I'm going to expect a yes/no response on you parting with cash. Building conviction, it's a bit like, Eren, if you offered to sell me your house for £2 million, I've no idea whether that's a good deal or not. You might pull together a lovely pitch deck. I'm unlikely to build enough conviction from that pitch deck to decide whether or not that's a good idea. I don't have 2 million, Eren, so I'm really sorry. But I would need to build a sufficient amount of conviction about essentially what's quite an expensive transaction for many people. Investors will be usually considering parting with a meaningful sum of money. And the idea that you would part with that sum of money as if it's, a cheap product on a supermarket shelf, it's just not the same type of transaction. And so I think founders that treat the assets as helping to build confidence and conviction in the transaction going ahead, a bit like having a floor plan for a house. or having a survey done that says whether or not actually the house is structurally sound. All of these things help you to build conviction as to whether or not you actually want to part with capital for a significant investment.
I want to dig a little bit deeper to that question, because in our Fuel Accelerator program, we are getting like interest from different levels of startups, from like ideation stage to the later stages. And for me, honestly, the biggest challenge is with the ideation MVP stage startups, because there is a chicken and egg situation there. Because when they ask me that, when it is the right time to start fundraising, it is really hard to answer this question, because when they go to the investors, of course, going to the right investor is an important topic that we're going to cover in a bit, but investors are looking for the traction. But for the traction, they need some money for it. That's why in this chicken and egg situation, they ask me that when they can understand that, okay, this is the right time to go to an investor, or maybe if there is not a right time to think about it, or they should go with the flow. That's why, like, for the most early stages that they don't know when to start fundraising, is there a specific timing or specific, let's say, feeling that they can understand that they can start fundraising?
It's a really good question, and ultimately it does vary, because for certain types of companies, there is no alternative than to go and raise capital to fund the initial product. But I think in many like service, like software as a service or other types of service or digital product based companies, you can actually generate a lot of proof of the existence of a market for that and how much people would be potentially willing to pay for it through proxy mechanisms. So it's great having an idea. It's great knowing that you need some capital to build out an MVP. But I think you can very often replicate you can evidence demand in a market without having a finished product. A good example, actually, from something that we're doing with a new product that we want to launch into the market, which is product for funds who are raising their next fund. We've got a wait list. We have funds signing up to that wait list to use the product. And that's evidence that there's demand for that product. Essentially, we've given a description of what the product will do. We've said, if you think that will be useful, here's a wait list that means that once we've released the product, you will be notified about it. And that shows intent from that side of the market. On the funds don't pay for that, by the way. We've got another part of the market that does pay for that, and they want data on the funds who are using the product. And so we've got evidence from the customer side of the market too that they will pay to access that data. So without having built the product, we have evidenced that actually the incentives and the mechanics are there, that ultimately this should generate revenue if that infrastructure exists. So I think from a founder perspective who's going through the ideation, they're thinking about MVP. Are there ways that you can, without investing in actually building the MVP, are there ways that you can evidence that there is demand, there is the ability to generate revenue from this, even if you're not sure about what the scale of that revenue is going to be? Is there a way that you can evidence that before you go out and start fundraising? And I think with the tooling that's available today, that means two things. One of which is it's cheaper than ever to build an MVP, at least one that can illustrate what the product ought to do in future. So that's one. And two, investors know that as well now. So going to ask an investor for 50,000 to go and code an MVP is something that fewer and fewer investors are going to do, particularly if it's software related, because actually the tooling that's out there means that you can probably recreate, at least in a very clunky way, that product in order to build the evidence of that product and to help the investor have more confidence in backing the company. And so I think that's actually overall a really good thing for founders, because it means you're wasting less time in terms of building things that people don't need. Two, actually, in theory, because you've got through that initial de-risking step, you potentially can walk away with more of the equity in your business, because you've proven more about the business's right to exist before going to ask someone for money. And therefore, the percentage risk on the business is lower. Yes, the barriers to entry are probably lower too. So there's a bit of a give and take there. But yeah, if I were a founder today, I'd think, okay, I'm at ideation. If I were a scientist and I were designing an experiment to prove or disprove that this is a good idea, what are all the things that I can do that would then give an investor confidence in funding an MVP? So very long roundabout way of answering the question.
It's great points, because when you were answering, I was also thinking that because of this new AI revolution, lots of things being disrupted. And also when we think about early stage, yes, you are right. If you have got a solid idea, and if there's a problem, and if there's a market, and if you can validate this idea, problem, solution with the tools that you can use, then it will be much more easier to go to the investors.
Just to add to that, Eren, the fact that you have LLMs out there today, you can also leverage that as a founder going through ideation to help you structure your own thinking about what a good test to set up would be around, like, what proxies could I use to evidence the need for this? And LLMs are great at helping you with that type of, you've got a general direction, but providing structure to that in a way that might help to build conviction, both for yourself and any prospective investor, about that being a good route to pursue.
Great point. And within the other questions, I'll be glad if you can always give some tactics from the LLMs in the fundraising part, because everything is changing so rapidly, and I'm seeing that lots of founders are trying to use lots of LLMs at the same time, sometimes maybe losing so much time just iterating with the LLMs. That's why in the following questions, if you have got any tactic that is related with the fundraising that is a good use of LLM, that will be highly appreciated. My next question will be about approaching to investors. This is also another area that most of our founders in our accelerators are having hard time. I'm sure that you have witnessed lots of mistakes that founders are doing when they are approaching to investors. What are the most common type of mistakes you see when they are approaching to the investors?
So I think the biggest mistake is one touched upon, like, when we first started this episode, which is many founders will approach investors as if it's going to be a quick transaction, and that the provision of a small set of information is going to give sufficient confidence to the investor to invest. And they're then approaching it as an almost immediate yes, no, as part of that conversation. So I think this is definitely not the case with, like, second-time founders, or indeed founders that have been in the market for any considerable amount of time. They're more likely to take a slower, let's get to know each other type approach, rather than essentially firing off their one shot very quickly when they've got a very low probability of converting that into an investment. So I think all founders that need capital are in a rush, but there are ways of maximizing, being 0% certain of £10,000 today. It's not worth taking that shot. And so by virtue of spending more time with investors, helping them build conviction and understanding about your business, you can increase that percentage before you take that shot. But it usually is just one shot that you've got in terms of that investor writing a check. Taking the time to help someone build conviction in your business is a worthwhile investment for both parties. So that's, definitely a big mistake is approaching it like a quick transaction, as we sort of in the parable of the house purchase that we had earlier. These things don't take time for people to build conviction on. So I think that's probably the biggest mistake that I see founders making, is approaching these conversations without providing enough time for someone to build a conviction to it. Yes. And I think actually one of the other mistakes that founders often make, myself included here, was not and this is earlier in the business, and actually LLMs have been brilliant for me, because I'm one of those people that when I start something, if there's the possibility of going off in multiple directions, I will, and I will never actually finish the thing, or very rarely finish the thing. What I've become better at over time is being like, actually, that's okay to go as it is now. But LLMs actually have been super helpful for me in terms of getting me to be more structured. So working out with an LLM questioning me, market sizing, particularly bottom-up market sizing, is super helpful. I always struggled to sit down with pen and paper or Excel sheet and just work that all out, because I would always go down every rabbit hole that there was to go down, and that was always challenging in a discussion with an investor when they ask you about market sizing, and you can't stay focused on keeping it tight as a definition, because that ultimately there are so many rabbit holes to go down, and invariably you end up doing that. So yeah, I think that from a mistake that founders often make is because they are so obsessed with the market and the problem that they're trying to solve is not keeping that tight. And so I think, again, tools can help you keep that tight or tight enough that it helps an investor to build conviction. An investor knows that there is a whole universe of opportunity there, but they might need a 2-page document on how you've sized the market rather than 40 pages. And so there's a balance there, again, like which I think through experience and having heard a lot of no's, like I have picked up myself, which is build something that's concise, gives enough detail to build a picture, but ultimately isn't going to boil the ocean and indeed boil a potential investor's brains by just trying to read through a document of all of your train of thoughts.
It makes sense, especially taking your time. It is very vital because, as you said, most of the founders are in a rush. And this is like, unfortunately, they are thinking that investors are waiting just to give their money. But at the end of the day, it's a monetary transaction. That's why instead of going more quick, I can understand, by the way, because it's a rush, because they are paying salaries, they are paying suppliers, the money is running out, that's why they need money ASAP. But at the same time, the counterpart, the other stakeholder investors, they are looking for the ones that can stay longer terms. That's why they are trying to choose their partners. That's why they are taking their time and trying to be more conscious about it. A follow-up questions with this one, just out of curiosity. When it comes to taking their time in the investor perspective, do you see any differences between the UK and US investors? Because my gut feeling says that UK investors are a bit more taking their time and US investors is more, let's say, quick. But is it the case in your experience?
Yes. Yeah, I think US has definitely got a more risk-hungry culture and appetite, and people. One, there is also just more money in the US market. It's a deeper pool of liquidity, which means that those who've got it are more likely to have more of it, and they're more likely to have more investments and be more comfortable with making investments. I think for us, especially starting out, like lots of our initial investors, friends, family, and work colleagues, essentially former work colleagues, for many of them, it's the first time that they'd ever made an angel investment. I'd sort of had to go through that process of learning with them, and it took time. This is no criticism of them, and actually the even more seasoned investors in the UK take longer to get to know you, to get to know the business. And there's, I think in the US, we've got a handful of the US investors, and their decision was made pretty quickly. It wasn't always a big check, but they came to a conclusion pretty quickly. And very often, because they're angels and they were cutting relatively small checks for them, they actually didn't require as much diligence in terms of wanting to check out the data room, which almost all of the professional UK investors did. That's fine. Like, they're just different approaches. I think UK investors are very much focused on capital conservation, whereas US investors are, how can I put fuel in your tank and get out of your way? And I'm not saying that UK investors are wrong for thinking about capital conservation. US is a market that just functions differently and thinks about risk very differently, and the way that they can help founders that they invest in succeed. The US market, I think, if I think about our US investors, and this again doesn't apply universally, US investors very happy to make introductions to anyone in their network that could be helpful. UK investors will do that, but it's not as widely across the board. There's a much more, again, like conservative approach of how do I retain both my financial capital and potentially political capital as well. So UK investors are often more reticent to one, open their checkbook, and then two, open their black book. Again, not universal, but if we compare and contrast, that's a bit of a comparison and a contrast.
It makes sense. I can also confirm similar, especially when we're comparing the US and UK investors. By the way, I totally agree with you. We cannot say that which one is the best way, because it is totally different ball games. I can understand that both of parties are playing the business game with a different type of strategy. That's why when it comes to the investor perspective, we cannot say which is right, which is wrong. Proceeding with my next question, there cannot be an episode about fundraising without talking about the pitch deck, of course. I don't want to go into the pitch deck technical details, But I would like to emphasize that in most of the conversations that I'm having with the founders, they are thinking that pitch deck is the fundraising process. It is like pitch deck is the, let's say, holy book. Everything is pitch deck. And if you have got the best pitch deck, you're going to raise the round. But when it comes to the investors, what are the things that they look beside the pitch deck?
So I think of the most documents that I see as being most important in terms of helping build the commercial conviction behind the business. Obviously, you've got your financial model, and everyone knows that the further from today that you go in the financial model, the less realistic, less plausible and likely that scenario is. You're going to miss it in a big way. You're either going to miss it by massively going under, or you might miss it by going over what the projections might say within the financial model. Nevertheless, there needs to be something there that shows the mechanics of how this business could scale. And so I think I'd say the financial model also then helps to illustrate the way that you think about growth of the company too, because you're essentially putting in the mechanics of the market and the way that you see those mechanics work. Now, this is where probably come as no surprise from earlier. I've always struggled with like knowing where to draw the line in terms of that's enough detail within a financial. I always like dig up and go down to the weeds. My co-founder is extremely helpful because he's very time efficient, and he will do the 80% of the Pareto principle, and rather than trying to go to 100% and burn much more effort in doing so. So you can definitely get lost in it, but nevertheless, it is a really good opportunity to illustrate the way that you think, both about the mechanics of the market, but also the mechanics of the way that the business is going to grow. And so I think actually the financial model is arguably much more important than the pitch deck. The pitch deck might be a grand vision, but ultimately the campaign map is going to basically have a closer resemblance to the financial model in the way that you've structured that financial model. I think market sizing likewise feeds into that, because again, it defines the terrain as you see it within the market and what you think is attainable with the company that you have and the company that you're going to have in future. So I think those are probably the most important documents, and pitch deck I would generally just use as like a high level introduction to the company and almost as like a teaser on the company that prompts a first meeting. You can have longer decks that explain more about the business, and that's fine. But in terms of the most important documents, I think market sizing and financial model are the two that I'd point to.
What about the narrative? Because recently, one of my close friends is about to launch a new startup. He's a serial entrepreneur. He's got several startups. He already exited one of them. And he was pitching me just for the practice. And he and his co-founder, both of them has got very decent backgrounds. The idea is very decent. It's interesting. It should be very appealing. But in the middle of the conversation, I told him that, because he's my friend, I became brutally honest to him. I told him that I cannot follow you because there is not a story, there is not a narrative. It is all about numbers, and I cannot concentrate to you at the moment. That I am your friend. I cannot concentrate. What happens to a stranger and with an investor? That's why I just suggest him, if you can give some human touch, maybe a narrative. For example, in the beginning of this episode, you tell that the ShipShape idea comes from your old profession, etc. That's why when it comes to narrative, what do you see how narrative is important when they are pitching to the investors, let's say?
And nothing wrong with what your friend's doing in terms of I think I almost certainly started out with boring friends and family to death by sort of quoting, made up numbers to them. So I think it's really common to not pin down your story arc or be able to correctly convey why something is important both to you and to them, and why it's a problem that's worth solving. So I think one, it's not uncommon to not nail down the narrative, but two, it is probably the most important thing about your business and the way that you convey it and communicate it. If you're not able to say why it's important to a friend, to an investor, biggest red flag in many ways is that you're not going to be able to do that to a customer. And if you can't convey why it's important to a customer, that means that there is nothing to invest in, because your means of getting revenue into the business isn't there, because ultimately the narrative that makes people realize that you're a solution for them isn't there either. And so I think it's definitely one of the areas that we've invested a lot of time in ourselves in terms of practicing, whether that's pitching, whether that's pitching to customers or users, or indeed to investors, or indeed just to audiences. This is part of our practicing as well. I'm experimenting with new methods of describing what it is that we do, or like aspects to our business. Like, I would always be practicing, and ultimately, so I was actually speaking with someone earlier who's looking at doing a research project into the language that founders use. One of the variables worth studying there is actually linguistic structures, but also how they potentially change over time as well. Because Bezos at seed stage almost certainly communicated differently to Bezos at sort of Series A and beyond. He's matured a lot, but he has focused on maturing that language and saying why Amazon's important and why they sold books to start with, and they now sell basically everything under the sun. Like, the US can't buy an aircraft carrier, but there aren't many things that you can't buy on Amazon these days. And that's, we know that in part because Bezos and now the team that succeeded him have worked really hard on that communication, that narrative, that story arc as to why Amazon is important in everyone's day-to-day life.
Exactly. Definitely. It's a process. I always tell the founders that it is test and learn. It's like you are pitching, you are at the same time, you are getting feedback, you are understanding what is resonating and what is not. And also it differs between the investor types as well, because I'm seeing lots of seasoned founders, they've got different type of narratives that they started to tell on the flow according to the type of investors. Because if the investor is more, let's say, technical oriented, the narrative can have a tendency to more technical details. But if the investor is more business oriented, the narrative should be more like, let's say, business oriented. Okay. And, my next question will be a little bit follow up. It is about the investors having trust, having confidence with the founder and building this relationship, building this confidence. Are there any red flags? Are there any behaviors that will make things in the wrong way in terms of founders, and that will make investors not to trust the founder in the early stages when they are interacting?
Story's not adding up. So if you're changing an aspect of potentially your past, or indeed what you see the future as being, if that changes significantly from one conversation to the next, and you're not able to evidence it in a, for example, scientific manner, I think if you're changing business model, we've done that actually a couple of times, we've pivoted. That's something that, one, could be an advantage as long as it's articulated correctly. So why have you changed something? If you articulate that correctly, that's not a red flag. In fact, for good investors, they would see, okay, they've analyzed the situation, they have picked up evidence that the current approach isn't working, they've changed it. That's a good thing. And similarly, the sort of the inverse of that also is true. If the current thing isn't working and you're not changing course, and you're speaking with an investor over multiple instances of that thing not working, actually for an investor that's a bit of a red flag. So how do you evidence character traits? Investors will be looking for character traits that are red flags, that mean that they are not going to feel as secure with their money. If your story is inconsistent, for example, referring to something that you have done or haven't done, or is easily disproven, like in case you want to sort of fluff up your CV, as it were, which some people feel compelled to do. Like, these are things that founders will go away and verify. Again, in the same way that if you were buying a house, you would usually carry out a survey on the house. Investors will sometimes do that with founders too. They will go and try and validate as much as they can of what a founder has said. So inconsistency between what you're saying and actually what's true will eventually reveal itself. And I think investors are generally smart enough to know when a founder is puffing up their CV, as it were, for the business. I think other things that are red flags are things like how you treat your staff. Like, what's the level of what's the relationship? What's the attrition rate of your staff? Companies with high attrition rates, for me, if I were a prospective investor, that would be a red flag. Like, what's happening with the company culture? Like, there are certain fintech companies, for example, out there that have extremely high staff attrition rates and people don't have good things to say about culture. If I were an investor, that's a red flag. And it's the sort of thing that you can expect prospective investors to do their research on, is to look into what's been the personnel headcount change in the last X amount of time. And I think LinkedIn now does that in certain instances for companies where it tracks personnel and headcount change over time. So that's, I suppose some examples of red flags for investors. I think also putting down things that are just completely beyond the realm of possibility with regards to what your projections and numbers are. Like, everyone knows that you're aiming high, but if you're saying that we're going to do 100K this year and 50 million next year without any increase in headcount in the company, then investors are quite rightly going to think, okay, this person is genuinely either deluded or stupid or both. And I think all founders have to be a bit deluded, but you can't combine it with stupidity too.
There's a very thin ice between being a delusional and being in the growth mindset, right? Very, very thin ice. Yeah, no, I strongly agree, especially with this company culture thing, because when I'm thinking out loud, as an investor in the early stage, you are investing to the founding team, their ideas, their ambitions, their background. But then when you come to the later stages and the company is becoming the asset, that's why if there is not a company culture, or if the company culture is, let's say, toxic, that might be a depreciating asset for any investor. That's why, even with the current investors, any red flag with the team and the company culture might be a bottleneck for the follow-up investments from the current investors as well. I've got one last question. If you need to give the founders 3 suggestions in their fundraising process, what will be these?
Always research your investor. So investors that understand the market that you're operating in, you're going to have better conversations with. Even if they're not a fit right now for where your business is, they will be far more helpful than speaking with an investor who doesn't understand your market. So I would always try and find which investors actually understand the domain that you're building in. If you're building vaccines for fish, speak with investors that understand aquaculture. But if you're building, the technology that's going to get us back to the moon, speaking with people who invest in aquaculture vaccines is not going to be as helpful. So it sounds like common sense, but actually it's common sense is too uncommon.
Exactly.
Yeah. And again, actually start by starting to build those relationships early in your journey. It makes things much easier down the line as well, because if you get to the stage where that person or that investor is a fit in terms of the stage and sector, then they've known you for potentially years by that point. And so that conviction may already have been built. That helps that journey. So you're almost preparing the battlefield of the fight in 2 years' time by doing that, and you're building essentially a network of alliances with people who want to see you succeed, which I think comes from people who really care about solving problems in a particular domain. So I think that's probably tip number 1. Do your research on who you're reaching out to. Tip number 2 has got to be approach it like a long game, in the same way and I think the house buying analogy works pretty well here. You wouldn't buy a house just off of seeing it on Rightmove or Zillow if you're in the US. You want to go see it. You need to go potentially do surveys on it, to ask potentially a list of questions before you start building that conviction and confidence. Think about buying an investor buying equity in your company in a similar way. And I would manage the process in a similar fashion to you, asking if they've got questions about XYZ, or what more can you tell them about the business that helps them to get comfortable with it. These are good approaches, and is ultimately then also considerate to the investor's interests, and making sure that if there is an alignment to be found, you are helping them to build that alignment and conviction in the company, and also who you are as an individual. What do we say? Do we say 3, Eren?
Yes,
okay, 3. All right. Third one, pitch deck. Just use it as a way of generating interest for a meeting. Don't think of it as essentially being the description of the business by which someone's going to make a decision, yes, no. And I think the moment that you think of it as a means to an end, and the end being a conversation, I think that's probably a better way to go. And I think many of the investors in our sort of last round actually didn't even look at a pitch deck. It was just over a series of conversations that they built conviction in the company, and don't try and just send out a pitch deck. If I'm speaking with an investor, or if I know that there's an investor of interest, starting with a pitch deck is usually a pretty bad way to go. Having a conversation is a much better way to go. Yeah. The other one is And I think it feeds into the point about the pitch decks is, if you go and ask someone who understands the domain that you're building in, and you know that they're an investor, if you ask them for advice about the market that you're building in, because they can genuinely offer you something useful, they're going to feel far more personally invested in wanting to see you succeed because they've given you advice. It's a really good way, again, of building alliances, as it were, winning a friend, and that friend might, as part of the way that they want to help you, might also want to invest. That's another really good way of asking for advice, get money, ask for money, get advice. Like many founders who've been through this process previously, I think can probably attest to that too. Like starting off with, this is a transaction versus I would like to ask for your help and advice or something. Like these are two very different starting points, and one, funnily enough, has got a much higher success rate.
No, I think that's a great tactic, because I would about to ask you a follow-up question about the first topic that you mentioned, that research your investor and start building your relationship early. Most of the founders find it very tricky and very hard picking up their brains, getting insights from them as the domain experts is a way of building relationships. At the same time, you say a very psychologically good tactic. Since they are putting input to the process, it will be much more easier for them in the near future to potentially invest to the project.
And even if they don't invest, they will still be helpful and want to help you along the way. Yeah. Picking up those friends along the way really does help.
Exactly. Okay, great stuff, Daniel, as always. Do you want to add anything to the topics that we have mentioned?
If you're fundraising, there's a search engine that you should use called ShipShape.vc. So yeah. Exactly. And I tell to our founders, startups in their accelerator programs, it's a no-brainer because it's free for startups. And what I like most about the product is, I'm seeing lots of LinkedIn posts about people are tagging something to the commons and they are sharing Excel sheets and blah, blah, blah. You also tell in the last three golden rule, research your investor is very important, because your analogy and your example was great. Like finding an investor for a vaccine in the fishing industry is a very niche thing. You cannot find it in the Excel sheets. You need to dig deeper to a platform, and that platform should have long tail information, not like just the VC names, their websites, LinkedIn pages. That's why I also strongly recommend founders, startups, are fundraising, go ShipShape.vc and use it for free. And thank you very much, Daniel, for coming here. If it works for you, I will be happy to do lots of other episodes with you to tackle other questions. We will be also doing a survey through our accelerator programs and asking our startups about what are the questions they would like to ask. These are the questions, by the way, mostly come from our accelerator site. That's why I can say that these are the questions coming from the field. And thank you very much for your time, and thank you very much for your insights. A pleasure as always, Eren.